The stock market is continuing to trade near all-time highs, which is making it challenging to find value in the markets. However, I am someone who believes there is always value somewhere, and every month I share 5 stocks that I think are looking potentially undervalued. So in today's video, I want to share 5 stocks that I think are looking interesting for the month of September. These videos take me a long time to research and record, so if you appreciate or enjoy them, then please remember to leave a like and subscribe for more. It really helps my channel grow. Now with that being said, let's dive into the video. Alright, now the first stock that I want to share with you all is the ticker symbol HIMS, which is Hims and Hers Health Inc. Now, this stock was actually a SPAC back here in 2019 and in 2020, and after the company did its SPAC, it saw share price growth of over 100%. However, since the peak there in 2020, which arguably was a bubble, the stock fell 86.66% down in 2022. However, the underlying business of HIMS has continued to grow incredibly well, and in my opinion, this is one of those SPACs that actually is a solid business that is continuing to grow. So now let's talk about what HIMS actually does. And here from their website it says, Hims and Hers is the leading health and wellness platform, on a mission to help the world feel great through the power of better health. No two people are the same, so the company provides access to personalized healthcare designed for results. So basically, HIMS is a platform that provides access to pharmacists and personalized prescriptions at an affordable cost. Currently, the business provides subscriptions that help people regrow hair, lose weight, manage anxiety, improve skin, and have better sex. All of these are to try and increase people's health and confidence, and I mean, who doesn't want all of these things that you're seeing on your screen right here? HIMS platform handles everything from intake, assessment, prescription, delivery, and support for the customer. It's a fully vertically integrated platform that handles the entire personalized prescription process, which is kind of hard to say. HIMS also has a 355,000 square foot pharmacy with fully automated packaging machinery. So you can kind of think about HIMS like the Amazon for online personalized prescriptions. The business is also seeing incredibly strong growth. Subscribers are up 43% year over year, and personalized products are up 164%. Now, the reason that this is such a big deal is because personalized subscriptions are much more sticky, which is helping HIMS build its moat and its competitive advantage within the industry. Now, if we take a look at HIMS highlights from its most recent quarter, which was the second quarter of 2024, we can see that revenue was up 52% year over year. Operating cash flow also increased by 219% year over year to $53.6 million, and free cash flow was $47.6 million, which is up 377% year over year. Again, we can see that subscribers did grow by 43% year over year, and the monthly online revenue per subscriber is $57, which is up 8% year over year. So not only are their subscribers growing at a very fast rate, but the amount that every subscriber is spending is also growing year over year. And these are extremely solid growth numbers right here. Here we have another screenshot from the most recent quarter highlights, and we can see that revenue came in at $315.6 million, which again was up 52% year over year. The subscribers number once again. However, right here we can see that the company raised its full year 2024 revenue guidance to a range of $1.37 billion to $1.4 billion. So the company raised its guidance in the most recent quarter as well. The CEO then says, our second quarter results mark an acceleration in what was already an incredible trajectory. So the company's growth is starting to accelerate. An approach to democratizing access to high quality, personalized solutions on our platform at an affordable price continues to resonate with consumers. So people in the United States are continuing to resonate with HIMS branding and the affordable price and the overall mission of the company to provide prescriptions at a cheaper cost to US citizens, which I do think is a pretty noble mission, honestly. All right, moving on to the company's balance sheet now, we can see that they have cash and cash equivalents of $129 million. We can also see that they have current assets of $291 million and total assets of $480.5 million. Now down here we can see that the total current liabilities for the company are sitting at $109 million, and the total liabilities for the company are sitting at $118.5 million. Now what this means is that HIM's current cash position of $129 million could wipe out all of the company's total liabilities, and they would still have about $10 million left over in cash. So HIM's balance sheet is incredibly strong, and it should not be in any financial stress anytime soon, because they literally have more cash than total debt. And yeah, this is just a great balance sheet. Now, moving on to the income statement, once again, we can see that they did $315.6 million in revenue, and their cost of revenue was only 59 million, which means that the gross profit was 256.6 million, or in other words, the gross margin for the business is 81%. Now, for those of you who may not know, this is a very high gross margin. This is like a software type gross margin right here. And this is the type of gross margin that businesses like Adobe see. So Hims is actually an incredibly profitable business. So then my question is, how is the company spending these profits? And here we can see that their number one expense is marketing, with $145 million spent on marketing in the last quarter alone. Now, if we compare this marketing expense to the company's gross profits, then it shows us that over half of the company's gross profits are going to marketing. And on an annual basis, this is about $600 million spent on marketing. So marketing is quite literally the number one expense for Hims. However, I do think that this is justified because the company is growing its revenue by over 50% year over year. So the marketing expenses that they are doing are clearly paying off and actually growing the business. But again, I do want to point out that Hims is spending about $600 million per year on marketing right now. So now let's head over to the cash flow statement. And here we can see that for the first 6 months of 2024, the company produced about $80 million in operating cash flow. However, we can see that stock-based compensation was about $43 million. So far this year, about half of operating cash flow has gone to stock-based compensation. Now, as Hims does continue to grow its business and its overall profitability, I do think that the stock-based compensation will not grow in a line with the overall cash flows, which is actually what we're seeing right now, because the company did $31 million in stock-based compensation last year, which was more than the company's operating cash flow. Now we can see that the cash flow has more than 3x'd, but the stock-based compensation has only risen by about 40%. So if the company can continue to expand the operating cash flow at a faster rate than stock-based compensation, then stock-based compensation could become less of an issue over time. And that's kind of my overall thesis with this business and its profitability and stock-based compensation. Additionally, we can see that the capital expenditures for the business were only $13.8 million, which means that the company so far year to date has done about $66 million in free cash flow, and the overall capital expenditures are very low for this business, which again is kind of like a software type company. Lastly, down here we can see that Hims is actually buying back shares, and they bought back $48 million worth of shares so far this year with organic cash flows. So that's kind of where the company's cash flows are going, which in my opinion is a good thing to see. All right, so now let's head over to Stock Unlock's freeform tool, and I want to show you some interesting things. So right here, again, we can see that Hims' gross margin in the trailing 12 months is now sitting at 82%. Now, Adobe's is 88.2%, now is 79%, and CRM, which is Salesforce, is 76%. And as I said earlier, this shows us that Hims' gross margin is in line with these software companies, and it's a very profitable business. Now, if we take a look at the free cash flow margins of all of these businesses, we can see that Adobe's is 31%, now is 30.6%, and CRM is 31.7%. However, Hims' free cash flow margin is only 8.4% in the trailing 12 months. So basically what I'm trying to point out here is that Hims has the same gross margin as these other software companies. However, Hims is spending a lot of money on marketing right now. And it is paying off again because the company is growing its revenue by over 50% year over year. So in my opinion, if Hims wanted to, it could cut its marketing expense in half, because remember, they're spending about $600 million on marketing per year right now. So even if they cut their marketing expenses in half, they would save $300 million per year. That would go straight to the bottom line and become free cash flow for the business. And in my opinion, I do think that if Hims wanted to, they could achieve a free cash flow margin of at least 25%, because they do have that extremely high gross margin. And it just makes sense to me because they're spending so much money on marketing. So what I'm trying to say here is the actual profit potential of Hims' business is extremely high. The company is just investing a lot of money into growth, which is kind of making it seem like this business may be more expensive than it actually is. But as an investor, what I am always interested in is the profit potential of the business. How much money could that business return to me as the investor if it chose to, and if it really wanted to just become a free cash flow machine, which I do think that Hims could do and become. So let me show you some of my thinking right here. So Hims is projected to do about $1.4 billion in revenue this year. Now, as I said, I do think that this company could achieve a free cash flow margin of at least 25%, which means that the company could be producing about $350 million in annual free cash flow, again, if the company wanted to, and if it wanted to cut down some of its marketing expenses. Now, the company is trading for a market cap of $3.2 billion today. So if we divide this by its free cash flow potential of about $350 million, then it means that the company is actually selling for about 9 times cash flow. Again, if the company wanted to actually convert its revenue into profits, which I think they could do tomorrow if they made that decision. However, this would sacrifice overall revenue growth, and I do think that the company is doing the right thing by pursuing revenue growth, but I'm just trying to show you the perspective of how profitable this business could be, and if it shows to be profitable tomorrow, what the price to free cash flow today would actually be. And in my opinion, a price to free cash flow of 9 for a business that is growing its revenue by 50% year over year, and it has more cash than liabilities, it's also founder led, and the CEO/founder owns 10% of the company. It makes a really good story that this business is arguably looking extremely cheap in the market today, especially considering how high its margins are and how high its free cash flow margin could be in the future when it does want to shift the focus from growth onto profitability for its shareholders. Now, the thing that is holding me back from this business is I simply don't know what the moat is, and I don't have high conviction in the company's long-term competitive advantage or its moat. I do understand that it offers personalized prescriptions, which is kind of a sticky business, but Amazon is getting into the online prescription space as well, and Amazon is trying to offer prescriptions through the Amazon website. So I don't know if Amazon is going to eat into this company's growth over the long term, or really if Hims is going to be able to fend off Amazon. I really just don't know. So that is something that I would want to look into more before I personally invest in a business, because I, as an investor, have to know what the moat is, and I have to have the conviction in the long-term competitive advantage of every business that I invest in. And I'm just not quite there yet with Hims. However, when I take a look at Hims' financials, I do think that this looks like a freaking slam dunk, and it is definitely an interesting company, selling for an arguably very cheap price. And for that reason, I wanted to put this stock as number 1 and dedicate some serious time to explaining my thesis here. All right, now let's move on to the second stock that I want to talk about in this video, and we're going to do a quicker one because I want to save some time after that Hims analysis. So this stock is NetEase, and the ticker symbol is NTES. NetEase says that it is a leading internet and gaming service provider centered around premium content, with extensive offerings across its expanding gaming ecosystem. The company develops and operates some of the most popular and longest-running mobile and PC games available in China and globally. I also have a couple of screenshots here from NetEase's most recent investor presentation, and we can see that 24% of the company's overall revenues does come from PC and console games, and then 76% of its revenues come from mobile games. So NetEase is a massive maker of video games, and specifically mobile video games like on the App Store. The company also has a 70% gross margin, and the gross margin has been continuing to increase over the past year. So the company seems like it is becoming more profitable over time as well. This next screenshot shows us some of the massive video games that NetEase owns. So here it says Lost Light mobile game, a multiplayer tactical shooter game, topped the iOS download charts in China following its June launch. Once Human, a multiplayer open-world survival game, attained over 230,000 peak concurrent users on Steam soon after its launch, ranking among the top 5 most played games in the world. Naraka Bladepoint mobile game hit the top 3 on iOS grossing charts soon after its launch in China. NetEase also writes, generated continued popularity of hit games, with Naraka Bladepoint reaching record high daily active users on its 3-year anniversary, and Identity V continuing its strong performance, hitting a record daily active users in July and August consecutively. NetEase also brought World of Warcraft back to China, with players enthusiastically welcoming the unfolding return of Blizzard's game portfolio. So NetEase seems like it makes smash hit video games, especially on mobile. And what's also interesting is some of its video games, 3 years after their launch, are still hitting record daily active users. So it seems like the video games are not one-time hits, but over time, more and more people download and play the video games as well. So now let's go and take a look at NetEase's financials here. And we can see that its revenue growth over the long term has been absolutely insane. and the company's revenue is continuing to hit an all-time high. If we take a look at the operating income over time, this is the exact same story, with the company's operating income hitting an all-time high in the most recent quarter as well. Next, I always love to take a look at the cash flows of a business, and we can see that the operating cash flow for NetEase is clearly uptrending, and it's sitting right near an all-time high right now. The capital expenditures relative to the operating cash flow are also quite low, at about 8% of overall operating cash flow. So this company is extremely profitable and a free cash flow machine, and it looks like they pay a dividend, they buy back shares, and they pay off debt with all of their free cash flow. And all of these things do create shareholder value, and I do like to see that the company is using organic profits to buy back shares, pay a dividend, and pay off debt. Now lastly, if we take a look at this company's balance sheet, we can see that it does have more cash than total liabilities right here. So just like HIMS, this company is in a very strong financial position, and it actually has more than double the amount of cash than it has liabilities. So this company should not be in any financial stress anytime soon either. So now let's take a look at NetEase's historical price to free cash flow versus its price to free cash flow today. And we can see that the stock is currently trading for a price to free cash flow of about 10.6, and its long-term historical average is about 21.3. So it's trading for about half of its long-term historical averages. We can also see that the last time NetEase traded for this price ratio was all the way back in 2013, which means that it is currently trading for about an 11-year low price multiple. And in fact, the lowest the price multiple ever got was back in November of 2008 at 7.7 times free cash flow. It's not quite all the way back down there yet, but you can see that this stock is currently being valued quite low in the market, especially relative to how it has been valued historically. And what's interesting to me is this business is continuing to grow its revenues, its cash flows, its operating income, and it has double the amount of cash as liabilities on the balance sheet. So trading for 10 times cash flow while seeing growth and having a strong balance sheet, I do think makes this stock look extremely cheap. And I think that this is because a lot of investors are simply saying that China is uninvestable right now. So no matter how cheap Chinese stocks get, there's a large amount of investors that are simply not going to be interested in these stocks, even if they're offering free cash flow yields above 10% and seeing the fundamentals of their businesses continuing to grow. Now, in my opinion, I think that this is just a pendulum. And right now, the pendulum is very bearish towards China. But historically, this pendulum has swung, and investors have been extremely optimistic and bullish on China in the past, and I do think that over the long term, the pendulum will swing back in China's favor. I don't know when that's going to happen, but if these Chinese stocks can continue to grow their fundamentals and basically perform extremely well, then I think investors are going to want to get back into them at some point. And then when that happens, the multiples will expand back to what should be fair value, because these stocks, in my opinion, are trading well below fair value today. So basically, NetEase is a massive gaming development company over in China that has a lot of extremely successful games that are continuing to see growth, and overall daily active users on these games are continuing to grow as well. The company's fundamentals are at an all-time high, continuing to grow. The balance sheet is incredibly strong, and it's trading for only 10 times cash flows. So for all of those reasons, I think that this stock is looking interesting and arguably undervalued in the stock market today. All right, now let's move on to the third stock that I want to talk about in this video, which is MKL, or the Markel Group. Now, this is technically a massive insurance company, but it also is kind of like a mini Berkshire Hathaway. And this company is actually referred to as the mini Berkshire Hathaway, because yes, they are a massive insurance company, but they also own and acquire a bunch of different smaller businesses, and they also have a massive stock portfolio that has been performing incredibly well. This business also IPO'd at around $7.53 in 1986, and since then, the stock has more than 200x'd and is up nearly 20,000%. And it seems like it just continues to grow and grow and grow. I do also truly believe that Markel Group is an extremely high quality business, as the principles and the culture of the business are a direct reflection of Berkshire Hathaway. This company seems like it is striving to become Berkshire Hathaway, or like a smaller predecessor. So what I want to do is actually read through the company's most recent letter to shareholders. One, because I think that there is a lot of great takeaways and learnings for investors. And two, because you can see an insight into how the management and the culture of this business is, how the business operates, how the business thinks, and how it also grows intrinsic value over the long term, and why I think that this business will continue to do so. So yeah, let's dive into the shareholder letter and I'll show you why I think that the stock is so high quality. All right, so the most recent shareholder letter is from 2023 and it starts off by reading, "These are the first words in the Markle style, our creed, written in 1986. We define success as building one of the world's greatest companies." You might ask, what does it mean to be a great company? 1. We believe great companies provide first-rate products and services. Customers then come back the next day. Quality creates referrals and a virtuous cycle of ultimate sustainability. 2. We believe great companies provide meaningful careers. The Markle style states, we provide an atmosphere where people can reach their personal potential. Thousands do just that. Starting with our IPO in 1986, we had roughly 300 employees. Today, more than 20,000 people continuously learn, create, and work for our customers. They help each other and work as a team. They also provide for their families and communities. 3. We believe great companies attract and maintain long-term, committed, and high-quality shareholders by earning excellent and sustainable returns on the capital needed to run the business. Then down at the bottom they say, by the time you finish reading, I hope you will share my optimism that we are truly on the path of building one of the world's great companies. So Markle seems like a very high-quality business with a great culture, and they are truly focused on creating one of the world's greatest companies. And they've been doing this for like 40 years now. All right, continuing on through the letter, this says, we started the year with an equity portfolio valued at $7.7 billion. We added purchases of $638 million and subtracted sales of $299 million, ending the year with a market value of $9.6 billion. We earned a total return on our equity portfolio of 21.6% during the year. So Markle essentially generated 21.6% returns on their investments in the year of 2023, and they were valued at about roughly $10 billion at the end of the year. Then they say, in our equity investments, we follow our 4-part time-tested and long-term discipline of 1. Investing capital in good businesses with good returns on capital. 2. Run by management teams with equal measures of talent and integrity. 3. With reinvestment opportunities to grow and/or capital discipline. And 4. At fair prices. Long-term readers of this report will recognize these 4 lenses. They have served us as unchanging principles for decades. Now, if you guys have read the Berkshire letter to shareholders, you will know that these 4 principles right here are basically a reflection of Warren Buffett's investment criteria. Markle has kind of reworded them a little bit, but these are the exact same things that Warren Buffett focuses on. He wants to invest in good businesses run by good management teams that have integrity, with reinvestment opportunities or essentially long-term runways for growth, and he wants to buy them at fair prices. If you have been a viewer of my channel, then you also know that I call these the moat, the management, and the margin of safety, or the 3 M's that I focus on when in my own investment and in my own portfolio. And this is where my ideas come from, by the way. These are not unique ideas that I have generated. I simply am copying the best investors in the world and applying their investment techniques and strategies to my own portfolio as well, because they're time-tested, they work, and these guys literally are the best investors in the world. So I love that Markle is following what Warren Buffett does, and it makes complete sense that this business is trying to become like Berkshire Hathaway. All right, continuing on through the letter, this says, as of December 31st, 2023, we now enjoy an unrealized gain of over $6 billion on our equity investment portfolio. With our approach to find common stocks that we can invest in with a desire to hold them for long periods of time, we can give ourselves a huge economic advantage over those who pursue shorter-term strategies, and we do. The long-term focus remains consistent throughout Markle Group, and it works. The beat goes on. So this company is also focused on investing for the long term. And for those of you who may have just missed, they have a $6 billion gain on their investments, and their portfolio of investments is worth $10 billion, which means that they have essentially doubled their money, more than doubled their money on billions of dollars. So their investments are working, they're generating extremely high returns, and they are basically partly an investment company. Then they talk about capital allocation, and they say, capital allocation decisions represent how we invest the earnings generated from the entire system. For example, consider the situation faced by the backers of the hit Broadway show, Hamilton. I'm confident whoever put up that money has indeed earned many multiples of their initial investments. But what are they going to do with the money? But can they reinvest the money they made at the same rates of return? And I think that answer is probably no. The ability to reinvest the money is a fundamental opportunity for the Markle Group. When we make money, we have 4 basic choices. We can fund growth in any of our current set of businesses. We can acquire new businesses. We can purchase publicly traded equities or fixed income securities, or we can repurchase Markle Group common stock. Now, what Markle Group is saying here about capital allocation is the company wants to be able to take the profits that it generates from its businesses and use those profits to reinvest at higher rates of return into further growth, either that be through acquiring new businesses, buying back shares, buying publicly traded securities, buying fixed income, etc., etc. But what the company's main focus and what the company's main goal is to be able to reinvest its internal profits into future growth at high rates of return. And this is what creates immense shareholder value over the longer term. And the example they gave earlier on in this letter is the backers of Hamilton, or the investors of Hamilton, probably received a lot of money from the Hamilton show, but they cannot reinvest that money back into Hamilton in any way, really, or to create a brand new Hamilton. Hamilton was kind of just like a one-hit wonder for these investors, and now they got to figure out what they're going to do with this cash to reinvest it, to continue growing it and creating shareholder value. Or in other words, there is immense value in businesses that can reinvest their capital at high rates of return. And Markle is one of those businesses that prioritizes doing this. And that is how they create intrinsic value and value for shareholders over the long term, just like Berkshire Hathaway. All right, now moving on through the letter, this gets into how the management values the Markle business. And we are going to use their technique here to value Markle's business today and then see what the share price is trading for. So they say, we'll cite orange and blue again this year to provide insight into how we think about capital allocation choices and how we make decisions on share repurchases. First, we think that there is an orange component of the value of your company. To figure out the orange value, we add up all of the investments and cash on our balance sheet, then subtract the debt that we owe. Second, we think that there is a blue component. To figure out the blue value of your company, we add up all of the non-investment operating income. We subtract out our interest expense and taxes to get a sum of the net income produced by our operations. Then we assign a conservative and consistent multiple to that total. We added the orange and blue numbers. We have calculated the intrinsic value per share following this method consistently since our IPO in 1986. It has compounded at a double-digit rate since that time. The share price has tracked that number very closely as well. Then the final piece of the shareholder letter says, our number one task as managers, measured in financial terms, is to keep the per share intrinsic value of Markle Group moving up and to the right at reasonable rates of return. When the orange and blue calculation indicates that Markle Group shares are selling at a substantial discount, our appetite for share repurchases goes up. If the market price exceeds our estimate, expect us to be willing to issue shares for growth, acquisition, or financing purposes. We are not going through this exercise to hype our own stock price. So there's a couple of things here. The first one is that the number one goal of the management at Markle Group is to create the per share intrinsic value, or grow the per share intrinsic value of the business. It's always great to see businesses that focus on increasing the per share value of the company, because a lot of businesses will focus on just making the business larger at the sake of diluting shareholders, which actually lowers the per share value of a share, if that makes sense. But Markle Group is quite literally saying that they focus on increasing the per share value of the business, which again is like Berkshire Hathaway. Then they also explain that they buy back shares typically when the stock is undervalued. And this is something that I talk about a lot, how businesses should only buy back shares when the stock is undervalued. And spending money on share buybacks when the stock is overvalued actually destroys shareholder value, believe it or not. It's actually a detriment to shareholders because that capital or that cash could be invested somewhere else to produce higher returns. And I write about this in depth in my book, The Fundamentals of Investing, which is available on Amazon, by the way. It's a great book. It's got great reviews. Check it out if you want to learn more about investing. But it's always great to find businesses where the management team only buys back shares when it actually creates shareholder value. In other words, they buy back shares when the stock is cheap. So now let's talk about Markle Group's valuation today. And I actually have a couple of screenshots here. So I added up all of the investment values on their balance sheet, and I found all of the debt and etc. And I found out that there is $23.4 billion of net cash and investments on the balance sheet when you subtract out the debt. So that would be the orange value that Markle is talking about, is that $23.4 billion. Now, on the income statement, I subtracted out all of the income and revenue from investments, and then I found the operating income, and then I subtracted out the interest expense and the income tax expense, and I found the overall net income from Markle Group's operations. And that number was $93 million in the first 6 months of the year, which on an annualized basis is $186 million per year. Now, Markle Group says that they apply a conservative multiple to that number, and I think a 10 price to earnings ratio is a very conservative number. So we go $186 million times 10, which is $1.86 billion. So then if we add up the $23.4 billion of net cash and investments on the balance sheet, and we add in the $1.86 billion of essentially operating business worth, we get a total value of $25.26 billion. Now, Markle Group has 13.08 million shares outstanding today, which leaves us with a total value of $1,931 per share. And this is kind of what Markle is suggesting that their share price could be worth. Now, if we go to Markle Group today, it is currently trading for $1,596. So if we divide this by 1931, which is the intrinsic value of the business on a per share basis, then we can see that the stock is arguably about 18% undervalued, or selling for a margin of safety of about 18%. And this is why Markle Group says that they believe their stock is undervalued today, and that is why I am putting it in this video as well. I think that Markle Group is an incredibly high quality business that is owner focused and also focuses on creating per share intrinsic value for its shareholders. It also has an incredibly long track record of growth and outperforming the overall S&P 500. I also think that this company has a long runway for future growth ahead of it, and it is trading below the management's estimates of intrinsic value today. Also, I'm not going to get into it in this video because I feel like this video is already getting very long, but Markle Group is trading well below its historical average price to book ratios, and its price to book is continuing to compound at over 10% annually. And therefore, if you want to value this business off of the price to book, it is trading below its historical averages, which could also suggest that the stock is trading for a discount relative to how the market has historically valued it, and the business's growth is remaining consistent at over 10% annually. And therefore, there is a pretty strong argument that the Markle Group stock is looking undervalued in the stock market today, and for that reason, I did want to put it as number 3 in this video. All right, now let's move on to the fourth stock that I want to talk about in this video, which is PayPal. Now, I recently did a full in-depth video explaining why I believe that PayPal stock is looking cheap in the market today, so I'm just going to do a quick summary of some of my thoughts. So right away, we can see that PayPal stock is down massively from its all-time high back here in, what would that be? July of 2021. The stock is still down roughly 76%, okay? Now back here, I do believe that the stock was actually quite overvalued, but I do believe that the stock is arguably looking undervalued today now. If we go and take a look at PayPal's revenue, we can see that it is currently sitting at an all-time high, and the revenue for PayPal does continue to grow. If we also take a look at the company's operating income, it is sitting at an all-time high of about $5.4 billion as well. Operating cash flows are also spiking, and PayPal is projecting to do about $6 billion in free cash flow for the year of 2024 now. The new CEO over at PayPal seems like they are doing a great job as well by reducing the stock-based compensation and really focusing on improving the overall business. He was a former executive over at Intuit, and Intuit has done an incredible job of growing the business, providing exceptional customer service and customer support, and overall just value to the customer, and creating shareholder value as well. So I think that he is doing a great job of kind of turning around PayPal's overall business and getting the business focused back on the things that matter and the things that do create shareholder value as well. Now, if we go and take a look at PayPal's historical price to operating income, we can see that its long-term average over the past decade since being a public company is a price to operating income of 40. Today, the company is trading for a price to operating income of about 13.8. And even back in the stock market crash of 2020, PayPal was trading for a price to operating income of 40. So this stock's price multiples have come down massively. And for this reason, I do think that the stock is looking cheap relative to how it has been valued historically and relative to the business overall today. So let's go over to Stock Unlock's discounted cash flow calculator really quick and use PayPal's operating income over the next 5 years. And even if PayPal grows its operating income at 5% annually over the next 5 years, buys back about 2.5% of its shares, and trades for a price to operating income of 20, which is still well below the company's historical averages, then the stock could deliver a compounded annual growth rate of 15%, which is well above the S&P 500's 10% average return historically. And if we scroll down, this would mean that PayPal would have to do about $7 billion in operating income by the second quarter of 2029. The company is currently doing about 5.4 billion, so it would need to increase its operating income by about 1.5 billion over the next 5 years. And when we take a look at the company's historical performance and growth rates, this doesn't look that insane, and it looks like this is pretty doable for the business. So for all of those reasons, I do think that PayPal is looking quite undervalued in the stock market today, and it is definitely looking interesting. All right, now the fifth and final stock that I want to talk about in this video is BN or Brookfield Corporation. Now, for those of you who have been watching my channel since 2022 at least, then you're probably quite familiar with this business because Brookfield Corporation is the largest position in my portfolio by far. This is the stock that I am the most bullish on over the long term. I simply think that this is an incredible business with an incredible management team that is focused on creating shareholder value. It also has an extremely long track record of growth, hitting their targets, and just overall being a great business. I also recently made a full, in-depth, dedicated video to Brookfield Corporation and its most recent earnings report, and why I think that this stock is still looking cheap, and why it is still the number one stock in my portfolio. And I was also recently buying even more shares of this business, as I do still think that the stock is looking cheap, despite it hitting a fresh all-time high today at the time of recording this video. So let me quickly explain why I think that Brookfield stock is still looking cheap and attractive in the market today. So Brookfield currently has a market cap of about $75 billion. So let's enter in $75 billion to our calculator. Well, Brookfield is also projecting to do about $5 billion in annual distributable earnings, which is essentially the company's metric for free cash flow. This means that the stock is trading for about 15 times free cash flow today, even though it is hitting fresh all-time highs today at the time of recording this video. Now, Brookfield is also projecting to grow its distributable earnings at 20 to 25% annually over the next 5 years. So basically, when I take a look at Brookfield Corporation, I'm seeing a stock that is trading for about 15 times cash flows, and it is projecting to grow its cash flows by about 20 to 25% annually. So that price ratio or price multiple for that level of growth, I do still think is undervalued in the market. And for those reasons, I do still think that Brookfield Corporation stock is cheap in the month of September as well. An interesting piece of information that came out with Brookfield Corporation is that Bill Ackman has added BN to his portfolio. I believe that he has about 3% of Pershing Square's portfolio invested in Brookfield Corporation now, but Bill Ackman is seen as one of the best investors in the world, and he has officially added Brookfield Corporation to his portfolio, which does kind of suggest that he thinks that Brookfield Corporation is one, undervalued, and two, a high quality business that he thinks will continue to grow over the long term. So it's interesting to me to see Bill Ackman add Brookfield to his portfolio. And I do think that this is kind of like overall a bullish thing because, again, Bill Ackman is seen as one of the best investors ever. So that's kind of my thoughts on Brookfield Corporation. For you guys who do watch my channel, yes, I do still think that this stock is cheap. Yes, it is still the number one position in my portfolio. And yes, I have recently been adding to my position and buying more shares as well. And by the way, if you are interested in tracking my portfolio, getting monthly portfolio updates, and staying up to date with all of the stocks that I am buying and selling in real time, as well as getting literally dozens of exclusive videos, then seriously go and consider joining my Patreon community. My Patreon community is how you can get direct access to me as well. You can ask me questions and etc. You'll also get access to my Discord community. So basically, my Patreon community gives you access to my portfolio, monthly portfolio updates, real-time buys and sells, a lot of stock picks that the YouTube channel does not see, Patreon-only videos, exclusive content, exclusive stock picks, etc., etc., etc. There is a ton of value over in my Patreon for anyone who wants to get more content from me in general, and it's only $10 per month. I've been getting a lot of great reviews. The Patreon-only stock picks have been doing incredible, and people seem to be very happy with my service over there. So seriously, go and check out my Patreon community, as it is the number one way to support my channel, and I do truly appreciate it. But with that being said, everyone, that is going to wrap up the video for today. And let me know what you think about these 5 stock picks down in the comment section below. Do you agree with them? Do you think that they are looking cheap? Or do you think that there is value elsewhere in the market? Let me know, and I will be responding to as many comments as I possibly can. But with that being said, that is going to wrap up the video for today, everyone. Lastly, if you did enjoy the video, please remember to leave a like on it. And if you're new here and you want to see more stock market related content like this, then consider subscribing to my channel as well. But that's going to wrap up the video. So thank you so much again for watching. As always, I truly do appreciate it. and I really hope to see you all again in my next video.